Hi everyone, hope you're all doing well, and today I'm talking about why I'm buying Hims and Hers stock. So this is going to be one of those deep dives into this stock and why I'm buying it, and I'll go through the reasons why in this video. I know some of you guys would really love me to do deep dives on every single video I do. The only problem is we're working a full-time job and then doing basically 5 videos a week on YouTube and then 2 videos that are exclusive on Patreon. I just don't have time to do the complete research into doing these videos. You know, they do take a good kind of 5 to 8 hours to complete to put them up on YouTube. So it does take a lot to put them in here. And this is one of those days where I do these deep dives. So if all I ask for is if you could hit a like button, that'd be absolutely amazing. And as always, this is why I am buying Hims and Hers. This doesn't mean that you can go buy it. Make sure you do your own research. And this is just my thoughts on it. And obviously, because I own the stock, I'm going to be a little bit biased and say it is a good opportunity here. But hit the like button and we'll take a look. So Hims and Hers is currently $6.62. Recently it's starting to have a little bit of a bounce. As you can see, we have come off the lows, which was $5.52, which is absolutely bonkers. And a lot of the stock market, a lot of the growth stocks are starting to have a bit of a rebound at the moment. But when you look at the long-term picture, I mean, all you can see is that little jump there. Realistically, you look there at the long-term picture and you're like, it might have been a bounce in the last few days, but wow. It's been painful. So yeah, it's fallen off an absolute cliff. But Hims and Hers is a stock that I started buying about 3 months ago. So my average is around about $7.50. So I'm about down 15% on this one. So not too much, but it's just a new position that I'm averaging in on, and I can't believe that it was actually at $5.52. But yeah, I've recently started building this position here. What happened to this stock originally is it actually came through a SPAC here about a year ago, and since then the SPAC actually went really high up. It got caught up in a lot of the hype around February time, and it did go up to 52-week highs of $25. And since then, it's just been downtrending, and gone lower and lower. And when it got back to SPAC prices, I was like, okay, this is really interesting now. Because for me, I look at the company from December time basically to July time, and I was like, okay, it's the same prices basically as before. I know a few people will shout out there's been dilution, but a lot of that has been for like acquisitions, and anything previously would have been through the SPAC anyway. So I'm not too fussed on that. But from when it went to $10 and it started going into single digits, that's where it did start to really interest me. And obviously it went down from, I think it came on the stock market as a 1.6 billion company, and then when it was down at 1.2 billion, I was like, okay, it's lost a lot of progress, and the financials this year have been really strong. So that's what got me really interested. I wasn't too interested in it around $14, $12. But as soon as it got to that single digit, I was like, okay, this is interesting. And then, yeah, I started buying, and my average is around $7. Now, it is really important to say that this company was only founded in November 2017. So you consider that that's a really short time. You know, that to get into a company that last year put in 148 million and was founded in November 2017, that is some serious progress here. So that's the first thing to shout out. You know, this company has put in some serious progress over the last kind of few years. And what basically Hims and Hers do is they've got basically a telehealth service, some products that are online with an actual healthcare advisor. Originally, they kind of started off as like a hair loss and ED products, and they've kind of expanded past that now. But the range of products they're expanding, and the big thing that they've had recently that's really benefited them is the CV. Now, this is for telemedicine rather than telehealth, but obviously they do kind of do a few telemedicine products. But you can see here, the big thing about CV is that it's brought a lot of this telehealth, telemedicine forward. This was obviously going to be an area that grows a huge amount in the next few years, but the CV has brought it forward even more. And going forward, telehealth, telemedicine, people want, especially when the younger generations come through, is the easy access on the smartphones, the apps, not having to actually go places to get these products or get health service. You know, these telehealth services were going to be massive in a few years, and all that CV has done is brought the demand forward, and it will continue to grow. So the big thing is, like, you look at the likes of like a Hims and Hers right now. In the last 12 months, you can say that the situation in the CV has only benefited it. And all that demand that's been pulled forward, and it's shown in the revenue. And once again, you look at the share price and you're like, okay, it's lower than where it was previously. So that's the first big thing, is that it is in a TAM that I really like. Now, back in 2019, and this was January 2019, this company was valued at 1 billion. So that was the valuation nearly, I guess, coming up to kind of 3 years ago now. And when it came on through a SPAC, it actually came on at the valuation of 1.6 billion. And this was on the 20th of January 2021. So basically in 2 years from the last previous valuation, obviously that means that it had jumped up 600 million in valuation in 2 years. Now I've got to say this valuation here was a little bit of a rich valuation. Even this was a little bit okay, not as bad as previously, but still you can see here that basically in the last kind of 2 years we've gone from a 1 billion valuation 3 years ago. 1 year ago we were at 1.6 billion, and we look now on the progress the company's made, and it's actually at 1.2 billion. And if you actually go off the price to sales ratio, it's actually the lowest that it's actually ever been. And if you look here from the actual progress that the company's made, you can see here from when they originally kind of raised the money last time they were private. You can see here this is the revenue that we're doing. You can see that the massive jump here in 2019. In 2020, once again you can see the massive jump in revenue, nearly kind of 2x revenue. And same again when you think of really hard comparisons, this year it's gone from 148 million and we'll do around about 264 million. So the revenue increase that it's been doing is really impressive. And the thing as well is that it's finally financially really healthy. You know, no debt on the balance sheet. It's 1.3 billion market cap, and it's got 252 million in cash, which is amazing. So that could be used for a lot of things going forward. So balance sheet is no debt, a very healthy cash position as well. And as well as being founded in 2017, obviously you would hope it has the founder still leading it, and it does. The co-founder, Andrew Dunham, is still there, and he's the CEO. He's also been increasing his stake a lot recently as well, and you'll see here that the top shareholders, a lot of them have been increasing their stake here, which is really positive. And he does own 9.6% of the company. And the big thing to remember is that Andrew Dunham, if we just flick back here, he is the founder. You have the founder here that is basically from November 2017, took this company from, you know, brand new to what they're going to do this year, which if we just jump back again, is going to be around about 264 million. So you've got to think that basically this Andrew Dunham has basically took this company from nothing to 264 million in basically 4 years, which is absolutely fantastic. You know, I mean, how many people out there can put that on the CV? So I think the management and the ownership they have as well here is really impressive. Now the big thing as well is like what we've seen here is they've done amazing going forward, but the execution as well of the company has been fantastic. So this year, when we went into this year, basically the company came out and said that the revenue is going to be in the range of 195 million to 205 million. Now we're on the third quarter of the year, so there's still one more to go. But look at the increase. This was off the last quarter. They're now expecting revenue to be in the range of 263 million to 265 million. So you look at the guidance they gave at the start of the year and look at the increase. This is because they've executed and grown a lot faster than what they thought. And look at that massive increase in the revenue, because they're absolutely smashing it here. You know, the increase is nearly, 30% of what they predicted. So that's a massive increase. Once again, the company's firing on all cylinders, basically delivering absolutely amazing revenue growth. So you'd think the stock price is going to be higher from a year ago. Nope, it has lost half its value from even SPAC prices, and then when you go from 52-week highs, even lower than that. So this is exactly why, this is a company that is at the cheapest valuation that it's ever been, and the financials have only smashed this year what they said they were going to do, which is impressive. Now going forward, what they're going to do is this. What I said earlier is the company basically started off with hair loss and ED, and the spend as well is pretty small in these kind of industries as well. Going forward, recently launched, it adds in 3 more different income streams for the company, which adds these 3 in here, and you can see the spend is are going to be a lot more bigger on this. And then when these companies, obviously what you can see here is the company historically absolutely smashes what it delivers when it does go into these industries. Andrew Dunham and the team have a history of executing absolutely amazing. As well as having a history of executing amazing, you would think, okay, now that Hims and Hers are now going to go into some more areas, more sectors, and then you add in these more here, then obviously if they nail them like how they've done previously, that revenue is only going to go up and up and up, which it has been doing. So this is basically Hims expanding into these areas and then potentially even more. And as well as that, a lot of these areas are more like SaaS models as well. So basically, if you're kind of taking up any of these kind of products here, a lot of them are SaaS, and with them being a lot of online or SaaS models as well, is basically the margins that the guys make on these products are absolutely amazing. So the profitability will come in this company very soon. And you'll see here that they've absolutely smashed it this year because they've been getting more and more deals. There's been a new partnership with Walgreens. You'll be able to see there's one here where it's going to start selling its products on Amazon US store, and another partnership here with another health store with 280 stores. So these are actually really new deals. These are actually these new expansions are actually in the last 3 months. So even though they've been smashing it like I showed you earlier on the financials, a lot of these partnerships that they've got recently aren't even in the financials yet. So these are more things that you'll see in 2022, and that's how it's just, you know, absolutely killing it on the revenue growth, is because of these partnerships. And the thing is, one negative that people always use against this company is, but it is a company that loses money. Well, if you actually dig into the financials rather than just looking at a number, you'll actually find out the company could potentially be very profitable if it wanted to. You look at the revenue here, and we'll just go off this last 3 months here of 2021, which is this up to September the 30th. Revenue 74 million. Look at the cost of revenue. It only cost them 19 million to get that revenue, which is great. So the gross profit margins are absolutely massive on the company right now. Now, the only reason why it loses money is because it's trying to take a lot of market share. You can see the marketing spend, also ramping up with a lot of acquisitions and the new partnerships, which is obviously 44 million, and that's why the expenses are so low. The actual service they do is really good money, but because they're expanding so quick, that's why it currently loses money. But it is proven that it's working with the growth. Now, people that are negative, which if you're still watching this video and you're negative on growth stocks, I don't know what you're doing. Go watch a video on Intel. But if you are kind of interested in growth stocks and you're potentially looking at this one, you understand what growth stocks do. Growth stocks are the ones that will potentially lose money a little bit, but what they'll do is they'll take market share. As they take market share as the years go on, eventually when the company matures and it has more and more revenue, eventually that will turn into profit and it will gain that market share and not have to worry about competition as much. So this company is delivering on that, getting the revenue growth up, getting that market share up, and then when it wants to kind of slow down that marketing spend and everything like that, then that will slowly turn it into profitability. Now, like I said, this company, in my opinion, could easily do profit. All it needs to do is cut a few of these down. If you cut a few of these down, you would see the expenses going down. If it just cut it by 27 million, you talk about a company that's break even. But they've really gone for it this year. You know, even if you just look on the last period, that wasn't too far off. So, you know, if you do want profit, obviously this isn't the company for you. But if you're worried about the profitability, I would say that you should be fine in this one, because like I said, if it wanted to, it could be profitable, and you can see from the margins they do make. All they would need to do is cut down the expansion, but I'd rather have the revenue growth, take that market share, and that means more revenue in the future and probably more profit in the future. So that's the video talking about Hims and Hers and why I'm buying this stock. Hope it was a little bit useful. Like I said, for me, it's a company that's delivered really good financials over the last kind of 12 months. But the thing is, when you look at the valuation is massively dropped off from the last kind of even 3 years ago, 2 years ago, 1 year ago, and is currently at the lowest valuation. So when I've got a company that is at its lowest valuation it's ever been, but the growth is absolutely, you know, 30% above where we were expecting it to be, I look at that and think the company's firing on all cylinders, and you're giving me a company like massively sold off. So for me, that is the perfect company to be buying. Obviously, with me buying this one, I do believe there's probably 100% upside on this one, but realistically, I could see this being a company in the next kind of 5, potentially even 10 years, that you start talking that crosses into a 10 billion plus market cap company, which would be really interesting to watch. But I do think at least there's probably a double the return on this one, and that's why I'm personally buying it. So hope it was useful. Hope that little DD into Hims and Hers was useful. If it was, hit the like button. If you're new and you found the video helpful, maybe subscribe, and I'll see you in the next video.